Welcome to the Women's Money Wisdom Podcast. I'm Melissa Joy, a certified financial planner and the founder of Pearl Planning. My goal is to help you streamline and organize your finances, navigate big money decisions with confidence, and be strategic in order to grow your wealth. As a woman, you work hard for your money, and I'm here to help you make the most of it. Now, let's get into the show. As we close out the year, I wanted to spend some time on an episode talking about money trends and top stories for 2025. I think having kind of a top 10 list for this episode is going to give us a deep dive into headlines. And frankly, I try to shy away from some of those headlines in the week to week when it comes to our conversations because so much is moving so fast. And also when it comes to money, headlines can often be a distraction and confusing. But if we take a full year and really look at the trends, I think that'll be helpful to kind of have a narrative and an understanding of what's going on in markets in 2025. So I hope you enjoy this conversation. So here's the top 10 list in no particular order, although I think number one really is the dominant story for 2025. And that is the rise and resilience of AI and artificial intelligence in stock market and, frankly, American culture themes today. So this was definitely a year. If you look, AI is the AI story in, kind of mainstream culture goes back 3 years to November, December 2022. If you'll remember, we had a really tough year in stock markets, but at that fourth quarter, there was basically an announcement, and OpenAI basically gave us access to ChatGPT. And since then, if you look at the dominance of the Magnificent Seven stocks like Apple and Google, Meta, they have come to dominate U.S. stock markets. When you look at it measured by the percentage these companies take up of the S&P 500, they're now about 30% of companies. And some insiders say that you can attribute about 3/4 of stock market returns over the last 3 years, which have been incredibly strong years looking since then, to returns from artificial intelligence. And so we both we saw a really strong stock market this year. Returns of the S&P, as I'm recording in early December, are up around 17%. We've also seen, kind of the market really taking its cues from news when it comes to deals and agreements between companies with exposure to AI. And what people predict is that we will continue to see the immersion of AI going into the future. There have certainly been announcements that there is going to be more and more investment into these, whether it's through data centers, companies putting part of their budget and in their capital expenditures into investment in AI. And then we also have, kind of a drumbeat of what does this mean for jobs? Will AI be replacing jobs? Is this a good thing or a bad thing? How will people graduating from college in years like this protect against AI kind of coming for entry-level positions? And so I don't think we can ignore or hide from the fact that we really have an AI tipping point where labor productivity is being boosted in many cases by AI, according to research, but also what does this mean for the humans, and will we be left behind? So it's a story that is a very human story. It's also something that we have some kind of secondary considerations. I've already talked about employment concerns, but on the flip side, in a country which has previously relied on immigration and as well as birth rates that were higher, with lower birth rates and a regime that is much less open to immigration, perhaps we have a population that needs to be supported by this additional productivity. But something I haven't mentioned yet is that generative AI also creates a huge demand for power. Of course, there are environmental considerations when it comes to this. US data centers are anticipated that they'll use the electricity consumption of many, many cities. Growth in terms of energy demand is not necessarily easy to predict as to how we're going to get that growth, because our the U.S. energy grid is very old, hasn't been keeping up with modern times. So much to keep an eye on as we go. And will U.S. consumers, take on the burden of hiked energy prices? Some say yes, and so both. I don't think that AI is going away, and when we do our top 10 story for 2026, we may be revisiting the same conversation. Number two, especially in the first half of this year, were President Trump's tariffs, and in the second half of the year, it's been accommodating the impact or the economic costs of the tariffs. So in the spring, we had tariff announcements. If you'll recall, there was kind of a hastily put together chart that just showed off the charts, increases to tariffs, and then there were deal by deal negotiations. And frankly, it is difficult to keep track at this point in time of where we are in terms of what tariffs are. What we do know based on federal custom duties and reporting is that fiscal year to date, as of the end of the fiscal year in the fall, that for the federal government, that tariffs has soared in terms of revenue collected to about 195 billion. Now that is not 3, 4, 5 times what the U.S. was collecting in terms of tariffs in 2024 and prior. In fact, in 2024, tariffs were about 118 billion. So this is not that first chart where we were looking at 50, 70, 100% tariffs. And that's why I'm saying it's really difficult to see how everything is settling out. Settling in. There have been delays in certain enforcement of tariff, and also there have been questions as to whether and how consumers are being hit by the pricing on these tariffs. I think that most predictions say that U.S. households, on average, will have a higher burden in terms of increased prices. That can create a budgetary strain, and also still deals being announced. One example this December was about $12 billion in subsidies to farmers who have been very hard hit when it came to tariffs, and just new trading partners excluding the U.S. on things like soybeans. So some revenue coming in, certainly other costs, whether it's to consumers or businesses, as well as a TBD for tariffs as well, where we'll have to wait and see how everything sorts itself out. Keeping with that government theme, number 3 is we had a brand new tax bill, the One Big Beautiful Bill Act, that was passed in July of this year. Now, there was, everybody knew there was going to be change when it came to tax legislation, because the first Trump tax legislation, the Tax Cuts and Jobs Act, was passed during his first administration, and it was set and scheduled to sunset many of the things that were incorporated into that bill in what would have been the end of his second term if he had served in quick succession. And thus, there was a known need for a new tax bill. Well, we've got that tax bill now passed almost solely by Republican support. And this is extending a lot of the details of the Tax Cuts and Jobs Act with a lot of new introductions, including lower, although not no, taxes on tips, overtime, as well as some tax breaks for those receiving Social Security. Again, it's not that you get no tax breaks or you pay no taxes when it comes to Social Security, but some extra considerations for some of those people. There are also some changes when it comes to what you get in terms of tax breaks if you're doing a catch up in your 401k plan if you're over a certain income. There's a lot of phase outs. What I will tell you is, first of all, you can listen to our past episode on the One Big Beautiful Bill Act, but I'll also mention that taxes are not getting less complicated. There's so many phase outs, there's so many inflation adjustments, which I think are important. There's so much to consider in terms of where your income lands from year to year, that the importance of tax considerations to everyday Americans and financial planners like me is only increasing. So much to consider and think about when it comes to the new tax bill, and we'll continue to get used to it as we go through the first tax filing season for the bill this spring. Okay, one more government mention for number 4. We had the government shutdown, which was an extended and much longer than average, if you can call a government shutdown average, situation. So this fall, we had the government shut down for 43 days. It is estimated by the Small Business Administration that they were unable to deliver 5.3 billion in guaranteed capital to small businesses. Certainly a big impact for government employees who had to bear the brunt of, in some cases, unpaid labor and or layoffs, as well as all sorts of functions, including the access to government data when it comes to, the information that we use to figure out how the economy is doing. We had delayed employment numbers, delayed GDP numbers, and so we'll continue to experience the ripple effects. And just in general, I think that there is less likelihood for cooperation and more divisiveness, as always, in Washington. So, to have 3 of the top 4 stories be about government, I think is just the way that it is in America today. And number 5 on our list is quasi-governmental, talking about interest rates. Certainly, President Trump is very wary of the current regime when it comes to the Federal Reserve. And in the spring, we'll have a new Federal Reserve chairman. There are a lot of pokes and prods when it comes from the executive branch requesting lower interest rates. We have had lower interest rates this year, although people who predict where interest rates would be would likely have predicted that rates would have fallen even lower. What we've seen, because interest rates have not been falling as much, is things like the 30-year fixed mortgage staying persistently high. So still on average above 6%, and even higher than that for some of the year. Those of us who are borrowers who have owe on credit card debt, student loan debt, have not had the relief that you might have assumed we would have. Conversely, those who are savers, because shorter term interest rates have fallen a little bit more, aren't getting paid as much on their cash. And so the yields that were 5 and in some cases even 6% on money markets are starting to fall. That is something where people may want to start to consider bonds instead of just cash, and they may have falsely piled too much into cash that should be invested for the longer term. So I anticipate that there will be an unwinding of some cash reserves, and certainly for those of you who are careful about your cash reserves, also some considerations for making sure that you're getting paid a good interest rate for your savings, which now is in the range of, I'd say, 3.5% to 4% instead of 5 or 6, like I said before. So the number 6 theme, and one that I think every household is feeling in different ways, is persistent affordability concerns. And for some, that affordability concern may be a feeling and not a reality, but for other households, those who are really living without a lot of leeway when it comes to extra savings. When you make a trip to the grocery store, things are more expensive. There's persistent inflation when it comes to healthcare, persistent inflation when it comes to paying for childcare or any type of caregiving. And just, it is really tough for lower middle class and middle class families to find the dollars to kind of make it through. I think it'll be interesting to see what the impact is of the new tax regime that does try to assist with families at lower income levels. But will that be enough? And just one of the most important things to consider, even though inflation has gone back into a range of, about 3%, 3 to 4%, not its lowest rate, certainly, but not nearly as high as we had in 2021, 2022, and 2023, is that people intuitively think, oh, prices are going to go back to where they were. But unless you have really intense economic upheaval where there's a major recession, major unemployment, and you have what's called deflation, then that just isn't typically the case. The other thing is we just have this economy where those who are not, kind of hooked up to the return train of the stock market and investment markets in general, are really finding it difficult to kind of get ahead. And so it's a case of the haves and the have nots, and there's very different outcomes for someone who's looking at inflation of 3.5 to 4, and maybe they're not getting cost of living adjustments in terms of their income, or if they are, they're not keeping up, versus those of us who have exposure to stock markets, investments, and your retirement accounts are reaching all time highs. Your brokerage accounts may be reaching all time highs. And so, unfortunately, we all see the difficulties that these disparities reveal. And also, this is certainly a very negative and pessimistic thematic when it comes to how you see this kind of the state of affairs for America. So those are, really difficult considerations. And there is just a lot of differences that kind of increase the major divides in terms of how every one of us sees the world. So a lot more division, ongoing division, and no relief in sight, unfortunately, when you assess, kind of how things went in 2025. Even though we're reaching all-time highs in terms of markets, people are very pessimistic about overall economic health when it comes to the state of affairs in the United States. Number 7, I'll just mention that there is more and more kind of influence from private equity and private debt in the country. So we know that stocks that trade on stock exchanges, those are publicly traded stocks. And a lot of the bonds that we purchase are financed through traditional channels like banks, and those are kind of corporate finance, less private. And then we have this whole ecosystem of financing through what's called private equity financing, and capital from private equity that is has growing a number of companies that are big companies, but companies with huge revenue, that are not choosing to go public and are held in private spaces. So this is our number 7. Private everything is what I called it. And when you think about this story, we understand private markets just generally as a culture a little bit less, like how they're financed, how you make money. There's a ton of money going into these spaces, both through institutions as well as wealthy investors. A lot of the AI story is being financed by private debt. So debt of non-banks being issued to companies to kind of keep their reporting to be off the books, and in some cases, not under the light of regulators. And so this is an ongoing theme over the summer and fall. The executive branch suggested that they wanted 401ks to have access to private equity and private debt. And so this theme is kind of spilling over into mainstream stories. A lot of you may work for companies that are privately owned or financed by private equity as well. For small business owners, they may be getting courted for offers to buy their companies by private firms. I know we've had clients who have sold to private equity. And so this is certainly a theme that seems to be a decade-long theme, something we'll continue to talk about, and is really important to be aware of. So I've gotten through this whole conversation thus far, and I would mention that we've also got to consider, kind of what's going on when it comes to your investment returns. And so, in that case, investments have been a really strong story in 2025. And if you look back on my list of the themes in 1 through 7, you'd say, gosh, I see a lot of reasons to be kind of pessimistic, Melissa, that this must have been a horrible year. But if you're, an investor, you're probably familiar that a lot of things investment wise have made money. Using just kind of a list of some of the major asset classes that I follow. This again, I'm recording this in the first 10 days of December. But bonds, as measured by the BarCap Ag, are up over 6%. And you can compare this to cash returns that are probably closer, if you're really well invested in a high yield savings, of about 4% or a little bit lower. Then looking at the S&P 500 and most traditional way to measure US stocks, were up over 17% year to date. Meanwhile, small companies, which really had a rough start, especially with the tariff announcements, they are up about 14% year to date. And then finally, actually, international investments are much less exposed to kind of AI economies and AI growth stories. And yet, international investments, especially because they haven't had their day in the sun more recently, are up 29% year to date, trouncing US and giving a welcome relief to someone like me who believes in diversification when it comes to types of investments. So this has just been a year where you could think of 100 different reasons for stocks to be lower and investments in general to be lower, 100 reasons to feel like the glass is half empty, and yet, or 1,000 or 1,000,000 reasons, and yet it is so difficult to take and extrapolate from headlines and know what's going on when it comes to results in markets. And so I always say that it is a futile exercise to predict. And in fact, it often costs you. And this would certainly be a year where you could have easily thrown in the towel in April when stocks pulled back almost 20%, or March and April when stocks had a massive pullback after tariff announcements. And yet, it pays in many cases to be glass half full when it comes to investing. And in this year in particular, in spite of those drawbacks, we had an aggressive recovery and quick recovery, I should say. Kind of extrapolating from headlines did not pay off, and instead maintaining discipline did. So a couple more stories left that are kind of on the outskirts of the economy, but I think are really important to note. First, in number 9 is changes to higher education. So we've had the Trump administration fighting with institutions, asking for payments. We've also had changes to when it comes to student loans. It's less easy to get forgiveness, less repayment plan options. Meanwhile, student loans are about $1.7 trillion in the economy in terms of debt, second only to home mortgages in terms of what's on consumers' balance sheets. And I just see a change when it comes to higher ed, where you really need to focus on the return on investment when it comes to education. This is how many of us build our human capital, is educating ourselves. And so it's going to be really important to be careful in considering what careers to pursue when it comes to next generations, and just something to keep an eye on when it comes to, kind of results and outcomes over time, because higher ed is a huge part of the economy. I probably am biased because I live near the University of Michigan, so it's a huge employer in our local area, but lots of changes going on when it comes to higher ed. And the number 10 theme for 2025 is the ongoing disruption that's coming from GLP-1 drugs. So more and more people are using these GLP-1s. But I had decided to include this in my story for several reasons. First, not just GLP-1s, but kind of specialized and more expensive healthcare discretionary choices. Now, I'm not debating the value of addressing weight concerns or diabetes, things like that. But just treatments that cost more are more and more something that we plan for with clients. And so making sure that you plan for your healthcare costs, know that those costs tend to run in advance of inflation at higher inflation rates. All of these things are important to consider. Also, though, interestingly, and we'll have to talk about this on a future episode, maybe with a psychologist, but I had a client who's on GLP-1s to manage weight who mentioned how they had a change in their spending patterns because of the GLP-1s. And I think there are at least early anecdotal evidence that much like people's addiction patterns may be interrupted by use of these novel drugs, also there may be a change in terms of spending behaviors where toward healthier spending or more controlled spending behaviors coming with these. But I think one of the things I always like to remind people is economic stories hit in two different ways. First, certainly, dining establishments are changing the way they offer and drinking establishments are changing the way they offer their menu because of the disruption of these drugs. But also, people will need to plan for their spending on them. And certainly, there could be an advantage to funding an HSA, so you get a deduction for some of the spending, depending on how the economic arrangement is. So just a lot of persistent changes. And when you look at that top 10 list, I like to kind of have some takeaways from there. I think number one, what I would say is that financial planning really matters, and investment discipline isn't going anywhere. So 2025 was a year that rewarded you for investment process, for thinking long-term and not short-term, and just investment discipline. And I think that is an age-old piece of advice, but no exception to 2025. Number two, I think that complexity is not going away. There are so many dynamic stories and so much changing in terms of the way the world works. And it's really critical to see and understand this without being overreactive. But like, for example, the new tax law has so many different parts of it. And your income may change from year to year as well. And so the value of someone who can kind of cut through the noise to tell you what's going on for your circumstances, someone who does the work similar to what I do, continues to be so critical. And number three, and I mentioned this earlier, but you cannot predict, but you can prepare. So those of you who have a financial plan, have a toolkit to protect your human capital, to be prepared if there's a job interruption because of AI, to understand how taxes impact your overall financial situation. And while we could have never, exactly known how 2025 would unfold, and heck, it was a really chock full of headline and things to deal with type of year. I think that understanding what's happening, having a narrative that's pragmatic, practical, that focuses back on what you can control, and not relying on prediction, not saying, I know I have a crystal ball, but do say that you use process and discipline in order to make your financial decisions, really continues to be rewarded. I can't wait to talk to you into 2026 to see what themes unfold. And in the meantime, wishing you happy holidays and have a great start to the new year. Thanks.
Thank you for listening to the Women's Money Wisdom podcast. If you found value in this episode, the best way that you can support the podcast is to forward an episode to a friend or leave a review. Go to proplan.com and the podcast link to get all the resources and links mentioned. This presentation by Pearl Planning is intended for general information purposes only. No portion of this presentation serves as a receipt of or a substitute for personal investment advice from Pearl Planning or any other investment professional of your choosing. Copies of Pearl Planning's current written disclosure brochure and Form CRS discussing our advisory services and fees are available upon request or on our website platform at pearlplan.com. The information that we share is meant to educate and inspire, not serve as personalized financial advice. Everyone's situation is unique, so be sure to consult with your own financial professional for guidance that fits your life. And just so you know, the opinions shared in this podcast are Melissa's own and those of her guests. They don't necessarily represent any organizations with which Melissa is affiliated. For more important disclosures, please go to our webpage at pearlplan.com.